My name's Theo Andrew, news editor ETF Stream. Joining me for Expert Investors, we have Edmund Shing, Global Chief Investment Officer at BNPWM Wealth Management. Edmund, thank you for joining us.
Pleasure, Theo.
So what is your market outlook for the next 6 to 12 months, sort of covering fixed income and equity side of things?
Well, let's start with fixed income. I think it's very much more what we call a carry environment. It's about harvesting the yield. I wouldn't hold out too many hopes of making outsized price gains. There is, of course, I think there is, of course, the possibility that we will see some surprising easing of inflation, more than is expected by the market at the moment, particularly in the US. I know the first few months of the year would be much more about US inflation being more persistent, yields therefore staying higher on bonds and bonds not performing particularly well. I think that actually could unwind as we approach the latter half of this year, because I do feel that there have been a number of calendar effects that have operated, particularly in January and beyond, and those will fade away. And I also think the US economic momentum is in the process of slowing. Demand, I think, from the consumer is slowing, and that should lower the inflation pressures, allowing bond yields potentially to fall, allowing for some perhaps modest capital gains, particularly in the US. But overall, much more about capturing yield, locking in the yield for the next few years, as opposed to worrying about or hoping for big price gains. When we come to stock markets, yes, of course, they've performed extremely well this year. Can we afford to be greedy for the rest of the year? I actually think most of the time we can. I do have a residual worry about how persistent the gains in US mega cap technology stocks, the Magnificent Seven, can really be for the rest of the year. They've done so well already. But I think if we look at overall stock markets, particularly excluding these 7 stocks, I do think there is still potential upside left in Europe, Japan, particularly in value areas like the UK. And I think emerging markets, including China, are also becoming more interesting once again after a long period where they've been largely ignored.
Yeah, great stuff. And looking at fixed income in particular, in terms of sort of asset allocation, what does that mean for your portfolio? Are you kind of shorting duration at the moment, or is it not quite ready for that?
No, we're edging. We have been short duration. We're edging back towards benchmark duration, which depending on the market could be about 5 to 7 years. I quite like locking in up to 5 years because the yields are still pretty close to what you get on the short duration, but you are of course locking it for longer. And I think particularly for conservative investors who want steady, reliable income, that's quite attractive. Harvest the income over the next 5 years. You know what the yield is at the start. Barring disaster, you'll get your capital back in 5 years. Then, of course, you can worry about reinvestment. So I think the conservative investors that worked well, particularly in the credit space, even though credit spreads on investment grade are relatively tight, I still think they offer decent absolute yields, particularly in Europe, where Eurozone investment grade credit offering close to 4% is still, for a European investor, pretty attractive.
Great stuff. And then on the equity side, you mentioned sort of Magnificent Seven concentration there. How are you kind of pitching that at the moment?
Well, I think certainly we are advising clients to think about rebalancing more towards world ex-US. As I said, Eurozone, still attractive for us. UK, again, has been a largely, I would say a hated market actually, but is coming back into favor. You've seen the spurt of performance in the FTSE 100. I think that can continue, spurred very much by merger and acquisition activity. I think Japan, been a fantastic story. I think that still has legs. And finally, as I said, emerging markets, largely ignored. China clearly has been a hated market, but as we know, if you look at, for instance, the Hang Seng China Enterprise Index, up 40% from the lows in a few months. So I think most investors remain to be convinced about China. Has it really got legs, or is this just a flash in the pan, dead cat rebound? Let's see. But I do think there is potential there for equities for the rest of the year.
Excellent stuff. And then wrapping that all in your kind of ETF portfolio, how are you using ETFs to kind of play those sort of narratives?
Well, the UK, obviously, you have FTSE 100 or MSCI UK ETFs. I like both of those. In fact, I probably marginally like the MSCI UK ETFs because you capture a little bit of the larger mid-cap stocks, which I quite like as well, particularly for this M&A aspect. Emerging markets. I think largely investors now are trying to treat China separately. So I think what I'd really like is the emergence of emerging markets ex-China. And then you can play China if you want to in a separate bucket, either via, if you want domestic, you have the A-shares ETFs. If you want overall MSCI China, or of course, you can go for the Hong Kong listed via the more Hang Seng listed ETFs as well. So you have your choice. You can pick your poison. And of course, for Eurozone, I particularly like some sectors. So the cyclical value sectors, Eurozone banks is a classic ETF I love. Yes, it has performed very well. But then if you look at the bank sector today, it's still valued at a rather depressed price to net asset value, price to book of around 0.65, 0.7 times, much cheaper than the US comparators. You can say the same for UK banks as well, by the way, but there isn't an ETF for that. Eurozone banks or European banks, you have ETFs, and I still think there's upside there. And of course, a great yield while you wait.
So you mentioned ex-USA, you mentioned ex-China. Is that a sort of a consequence of you being more granular in your sort of asset allocation decisions?
I think it is, but it's also a reflection, particularly in the case of the USA, the fact that if you take a classic MSCI World or even an MSCI All-Country World Index, which in theory is very diversified, covering thousands of global companies, actually right now, the super performance of these mega cap tech stocks means that, for instance, if you buy MSCI, even ACWI, you still end up having 19% weighting to 7 stocks, which is just unprecedented concentration. So, whether or not you believe that's going to be the case, simply from a risk management perspective, we think it makes sense to diversify our clients away from that, reduce that risk, which is why we say MSCI World ex-US may make sense. You can still buy US exposure, but then maybe think about an equal weight ETF, or even think about mid and small caps, or think about an MSCI USA X Technology ETF. And of course, we have all those ETF choices as well.
Are there any areas of the ETF space you'd like to see more product development or innovation that you think could be useful for your portfolio?
Yes. I think particularly in the fixed income and in the credit fixed income space, I would like to see a little bit more diversification, particularly in terms of non-market cap weighted ETFs. Because while market cap ETFs may work pretty well in the equity space because effectively you're buying more of the winners, you're buying more of the momentum effect, in the bond space it's actually very different because you're buying the biggest bond issuers who actually may be the worst, either country issuers or company issuers because they've got the most debt. So you may not want so much exposure to those. You might want more exposure to the better lenders who maybe have less debt. And of course, if you take a market cap weighted fixed income or credit ETF, you therefore get a bigger weighting maybe more to those issuers you don't want so much weighting to. So something that reweights either on an equal weight basis or on a smart basis, taking into account quality like credit rating, I think makes more sense from my point of view.
Coming on to the kind of challenges of using ETFs in portfolios, what are the kind of main challenges from your perspective in terms of?
Well, I would say sometimes working out what the differences between the ETFs are. There are so many, as we know, there are thousands of ETFs, even in Europe, UCITS format, thousands. The problem I have is there are too many Me Too ETFs from different issuers. Trying to work out what the differences are, what the advantages are, liquidity, spreads, maybe small differences in the underlying indices. It's a bit of a minefield and very complicated and takes a lot of work for sometimes not a lot of rewards. So that I find a bit frustrating. Secondly, let's not forget there are also areas within the asset allocation space that are still not really very well covered or not efficiently covered by ETFs, and where active managers can still contribute. For instance, emerging markets, small cap spaces, Japan. These are all areas where typically active managers, even over the long term, even after the extra cost, have outperformed sort of index-based ETFs.
So yeah, are you convinced by active ETFs? Do you think they have a role to play in the portfolios?
Well, if you use active funds already, why wouldn't you use active ETFs? I understand from the issuer's point of view, it can be a bit of a minefield because do you really want to give away all of your high conviction positions? With an index, it's fine, you're following an index. But when you're an active manager, you're not following an index. That's the whole point. So do you really want to give away where your highest convictions are? Because that's the hard work you've put in. And the risk is always that you allowed someone to freeload on your hard work for free.
Yeah, absolutely. And finally, do you expect your ETF usage to kind of increase over time? And if so, kind of which areas do you think?
It's inevitably going to drift higher over time for cost issues. We have intense pressure on us to deliver greater and greater value to our clients. And one of the ways we can do that is obviously by reducing operating costs, in particular, the management costs of the funds that we use. So, given the fact that on average, ETFs are able to provide generally far lower cost, particularly for things that are fairly vanilla types of exposure, like S&P 500, MSCI Europe, inevitably there will be more pressure to go down that route. As I said, it will never be 100%, and it will always depend on the underlying liquidity of the ETFs. We need sufficient liquidity because when you trade in size, we're not trading a couple of shares here and there, we're trading big blocks. We need to be able to satisfy that demand without moving the price significantly.
Brilliant. Edmund, that's really interesting. Thanks so much for joining us.
My pleasure, Theo.
Brilliant.